Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Friday. It's December 8th. It's about 7:43 in the morning. The market's going to gear up to open up in about an hour and 40-something minutes. Too early to do math for me. The NASDAQ is down right now, pre-open about 45 points, just a little bit below random. The Dow's down about 39 points, very, very random. Anything below 100, 110 is just randomness. And the S&P 500 is meeting us in between. Now, today's a very, very important day. Why? Because we have a major report. We have an employment data. This report is going to be followed by the Fed, and it'll give us a really good idea of whether what they're doing is working and how effective it is. Because if the employment data reflects the ADP report, it means that employment is tighter. And if employment is tighter, there's less inflation. And if there's less inflation, it's a good time for the market. However, the ADP report has been wrong in the past about 3 out of 4 times. And if the employment situation is worse, if basically unemployment rate is 4.1, or the non-farm payroll numbers are worse, it means that employees are still in control. And if employees are still in control, that means it's inflationary because they could set their prices. Whereas if employers are in control, the job market gets a lot tighter. So it'll be a really interesting report, and it's one the Fed will pay attention to. One of the things you want to pay attention to while you're looking at this report is, let me just show you here, is the bond market. Now, you could do it 2 ways. You could go to the futures, and you can go to financials, and you could look at the 2-year, which has the most sensitivity to interest rate announcement. And I'll just show it to you right here. Actually, not December, March is better. And this will give you a really good idea of what the Fed is thinking. This is a short-term bond, and it's been moving higher. Let me just go to daily nearby. There we go. It's been moving higher, but the last few days, it looks like it's starting to cool off a little bit, and it may come back down. And if it starts coming down, it's going to have an impact on TLT, which is the long bond. And the long bond is already looking a little weaker. It was down yesterday. It's down today. And this is what I've been warning folks about. Now, as I go through this, it's going to be very important for me to show you the stock market. So this is the stock market. I drew this red line a while ago. But you could see right now where we're at. We're at a resistance level. And I warned you that if we can't get past this resistance level, the odds are pretty strong that we're going to be coming back down. Well, this rally, this is a weekly chart. Let me go to daily. This rally, this 10% rally you saw in November was sparked by the fact that bonds are going higher because bonds are implying that the Fed is not going to raise rates. And that the Fed is going to lower rates in March. Now, I'm not going to go through this because I've gone through this at least 20 times, but I think that's asinine. And what's even worse is the odds that's priced into this bond market right now is over 50%. I'll go through that in a minute. I think it's like 53%. So to me, this is going to do a lot of backwards. This is going to undo because things are not that good so fast. This is optimism. This is speculators driving optimism. The reality will set in and will probably go somewhere halfway. And once this starts coming down about halfway, and I'm pretty sure it will come down at least to the 100-day moving average because it hasn't even hit the 200. It'll come down here for a rest pause. This will put pressure on tech stocks and all the stocks that have been going higher, because once interest rates starts going higher, which means bonds going lower, let me just go here. This is interest rates going lower. Remember, they're inverse. Once this starts going down, that means interest rates go higher. Remember, inverse relationship between bonds and interest rates. So you have to be super, ultra careful. If you're not really, really careful, it's going to mess you up because the market is really inflated. There's hardly any stocks making 52-week lows. Let me show you something right now. Look, for example, let me just give you a quick example right here. Look at the number of stocks making 90-day breakouts, okay? 203. Look at the 90-day breakdowns, 40. 203 versus 40. How about 20-day breakouts versus 20-day break? This is 90-day. Let's go 20-day. 232. Let's do 20-day breakdowns. 49. So here's the problem. A lot of stocks, and this is really, really important. This is what you need to pay attention to. The trajectory of the SPY, has caused a lot of stocks to start making 90-day high, 20-day highs, and hardly any stocks, look, 49 are making 20-day breakdowns. That's really, really low. 40 stocks making 20-day breakdowns. That's really low, and that's including indices. So, for example, if I go here, you'll see Pfizer, Exxon, Excel. This is a ETF. It's a lot of stocks, a lot more stocks. Last week, it was a lot less. Another ETF, another ETF, another ETF. So this, another ETF. So my point is this 40 number includes ETFs too. And there's like 10 ETFs here. So the number is really, really small. And that creates a problem because what do? We trade breakouts and breakdowns. And if you don't have any breakdowns and you have all these stocks going up and you all of a sudden have a breakdown, you have to wait for those stocks to break down, right? They have to wait for the index to go down. All stocks follow indices. So we're in a position right now where if the stock market starts going down, okay, it's going to start triggering all of those stocks that have been going up, but we have to wait for it to break down. But even with what I'm seeing right now, aside from energy, there's several stocks breaking down. But energy, not energy, that's important. Non-energy, that's important. Energy. Don't know what this is. Energy. This is not energy. Energy. Do you see the point I'm making? So what we need to do is pick out the stocks that are not energy related unless we want to short energy stocks, which could be an opportunity too. But my point is the markets are really, really poised to the upside right now. And it's going to take a little bit of time, even if we have a shakeout from the report, it's going to take a little bit of time for things to start coming back down. So we may have very few options. When I say options, I mean choices, not actual options, of stocks to trade to the downside because we have to wait for momentum levels to settle down, which is one of the reasons we've been so calm and not trading a lot. Because the upside is a little stretched out. We're afraid that this is going to start bending, and if it starts bending, it's going to be a while till it gets up here, which means we're going to be stuck in a lot of long positions. And if we want to trade to the downside, it's hard because most stocks are up here. So we're in a kind of like a twilight zone situation where we have to wait for this report to figure out where things are going to go. Just wanted to explain to you all the underlying factors. Let's talk a little bit about global economy. So we're looking forward to the private monthly U.S. non-farm payroll report for clues on Federal reserves. Tech-heavy NASDAQ outperformed major benchmarks, underpinned by 9% surge in AMD. We sold puts on them the other week, and we profited yesterday. And today we're going to take profits on Meta. I'm talking about the weekly cash flow program. Labor Department Thursday showed that unemployment. Remember what I showed you? It's been literally the same levels all year long. There's now a 51.9% chance that the Fed is going to cut rates in March. I think they're on I think that the market's on drugs if they think this is a reality. I did a survey in my VIP room, and only 9% of the folks who we surveyed thought that this was going to happen. So I'm in that camp. Today we're going to be looking at non-farm payroll. Last time it came in 100. They're looking for a forecast of 180,000 compared to previous value of 150,000. We'll see what happens. Michigan consumer sentiment. Now, usually this report is important, but obviously they decided to put it right after the report. So we have a double whammy. We're going to have at 10 a.m., which is one of the reasons we're not going to trade before 10 a.m. We have a major report at 10 a.m. So we always wait for the first half hour of the day before making any major decisions. Europe is giving us a little bit of a tailwind. They got Germany's inflation data. Luxury and energy stocks are doing pretty well. China closed slightly higher as investors exercised caution amid concerns about the country's weak recovery. They're really pulling us down. The index ended the week lower as investor sentiment was adversely affected by Moody's issuing a downgrade warning on China and Hong Kong's credit ratings, further intensifying concerns about China's already fragile economic recovery. Japan closed lower, not giving us any tailwind. Growing speculation about the conclusion to the Bank of Japan's negative interest rate regime as soon as this month. Bank of Japan Kazoida. That's right. Kazoida stated on Thursday. I warned you about this like 7-8 months ago that they're going to start cutting their negative interest rates. Has options regarding which interest rates to target once it withdraws short-term borrowing costs from negative territory. That's one of the reasons Warren Buffett decided to invest there. Now, let's talk about charts and sectors. So, this is important. I want to break this down for you guys. I do this every day, but it's more important now than ever. So if you look at the last 6 weeks, home builders, real estate, semiconductors, Russell 2000, technology, consumer sentiment. The last 3 weeks, where are the semiconductors and Russell 2000 still there? But look at technology, QQQ, consumer discretionary, semiconductors. Not looking good at all. Now let's talk about the last 5 days. Home builders, retail, Russell 2000, mid-cap, smaller stocks. Smaller stocks are rallying, folks. That's a good sign, actually. That's a sign that interest rates are peaking out. Consumer discretionary, consumer sales have been strong. People are spending money. Real estate, interest rates going down. Industrial, don't know what utilities are doing here, but you can clearly see that QQQ, semiconductors, technology, they're all on the downside. They're not doing really, really well. And if you look at the chart, you will see, look at home builders. Nice. Look at retail. Not bad. Look at small caps. Look at mid caps. But look down here. Look at the energy sector. No good. Basic materials. Looks like it's got some catching up to do. Consumer staples looks pretty good. The S&P 500 looks like it's sitting right at year highs. Semiconductors, they've been going down. Financial, they've been just kind of sitting around. Technology, sitting and waiting, coming a little bit lower. Everybody's waiting for this report today. But again, the markets are all near the 52-week highs except for the energy. So if we start backing up and start looking for stocks to short, we're going to have to be really, really careful and only pick the weakest stocks. Now, before I go, I want to give you some numbers. Here's the Dow. Keep your eye for the 8-day EMA. This 8-day EMA right here is actually really important. And if we start breaking below the 8-day EMA and start coming down, that's a bad sign. QQQ, and again, don't make a determination of what the Fed's going to do right after the report. Give the market some time. So the QQQ has been going down. Again, it's above the 8-day EMA. If it starts really breaking down below this level, things can get nasty. And if we break below this level, we're going to go right into this gap right here. So really, really, really important to watch this level, which is a 382.90. That's that gap level. Very important. Now, folks, I want to make sure, if you don't know this, I'm going to do my VIP room at 11 a.m. today. Not noon, 11 a.m. Eastern time. The link is below this video. If you don't know where to find this video, go to YouTube, go to Roger-Scott. You will find this video in the channel, subscribe to it, and subscribe to my Telegram channel. You get free trades there. Go to rogerscott.com. That's rogerscott.com/Telegram and get the goodies. I give a lot of free trades, pictures of Clyde, my assistant, quote unquote, my cat. And anyhow, join me. It's below this video. And now, finally, before I let you go, folks, this is big. Get ready, folks, because at 1 p.m. Eastern time today, not today. What am I saying? On Monday, not today, on Monday. Yes, 1 p.m. Eastern time on Monday. Get ready to see our number one on-the-clock stock and which date it rises every year. That's right, Graham will have trades some of the best on-the-clock stocks at absolutely no charge. What are on-the-clock stocks? They're tickers that have paid out year after year on the same dates over the last decade. Always trading on the same specific date, never ever failing yet to hit a payout. Of course, we can never promise future returns or anything against losers, but we will give our favorite tickers and dates for each month of the year. It rises Monday at 1 p.m. Eastern time. Don't forget, Monday at 1 p.m. Eastern time. Follow the link below. Reserve your seat now. Look, Graham's mom, Celeste, she's red hot. If this guy is as good as Celeste, you've got yourself a winner, and he's on fire. I'll see you guys on Monday. Have a great time. And if you have any questions, Roger at rogerscott.com. Bye, everyone. Have a great weekend. Any questions, send me an email.